Hello, friends, and welcome back to Finogent Market Insights. I am Rajadhar, managing partner at Finogent Solutions. And if you are watching this, then you are one of the very few individuals who are actually taking very serious note of their investments. Now, whether you are managing a substantial equity portfolio, exploring alternative assets, or diversifying across multiple asset classes, today, together, we would be analyzing the week that ended in the November 7th, 2025. What we witnessed tells us a lot about we are in these market cycles. More importantly, whether opportunities lie for sophisticated investors or not. So grab a notepad because we are going to deep dive into numbers, the narratives, and more importantly, what you would be doing with your portfolio right now. Let us start with a headline numbers. The Sensex closed at around 82,763 points on November 7th. That is decline of around 0.66% for the day. Now, before you get concerned, let me put things into context. Over the October and early November, the index actually climbed around 1.21%. The Nifty 50 ended 25,492 points. Now, marking this as a second consecutive week of losses after a phenomenal 1,500 point rally over the previous 4 weeks. What you are seeing here is what tactical analysts call as the shooting star pattern on the weekly chart for the second week in a row. This indicates short-term indecision. After a strong rally, markets are catching their breath, reassessing valuations, waiting for the next catalyst. But here is what most people miss, and this is crucial. The broader trend remains structurally bullish. We are not seeing a reversal, we are seeing consolidation. The volatility we witnessed throughout the week, bouncing between the mild gains and the sharp declines, this is just completely normal behavior after such a strong run-up rally. In fact, it is healthy. Markets don't move in the straight lines. Whenever the market goes up, it has to take a breather. And this is the foundation for the next leg up. What is our point of view? At Finogent, we view this consolidation as an opportunity and not as the threat. The Nifty itself has a very strong technical support going on these days. If you have a 3 to 5 year of the horizon, each of such consolidation phase which actually give you an opportunity to at least reposition your portfolio, deploy excessive cash lying with you, but still keep some dry powder with you. These are the things that you need to take care of. Now, the FII-DII dynamics. Now, let us talk about something that is absolutely critical to the understanding of the market direction. Foreign portfolio investor flows. Yes. After 3 consecutive months of outflows that had everyone worried, October 2025 marked a dramatic reversal. Foreign investors pumped around $1.66 billion into Indian equities. And believe you me, if you look at the composition, the France led it with around $2.58 billion of equity investments. The United States and Germany each bought around $520 million. Ireland, Malaysia also turned buyers. So this wasn't just 1 or 2 countries. This was a broad-based confidence in the Indian story that triggered it. Now, what are the reasons that trigger this reversal? First, robust corporate earnings from Q2, that is Indian companies actually delivered. Now, secondly, beating expectations across the sectors. First, robust cooperative earnings from Q2. Indian companies delivered beating expectations across the sectors. Second, the US Federal Reserve's dovish stance actually continued rate cuts, making emerging markets like India more attractive on a relative basis. Thirdly, this is often underestimated. Growing optimism over the US-India trade relations improving. And this is important. Early November has shown some reversal. FIIs have engaged in significant short selling that is currently outweighing domestic institutional buying. Now, this creates near-term pressure. What is our point of view? How we are reading this at Finogent? The October reversal in FII flows was structurally significant. It wasn't hot money chasing momentum. It was a long-term capital recognizing value. And that money actually flowed in after quite a long lull. The earlier November profit booking is tactical, not strategic. How we look at it, please do not get distracted by week-on-week FII flow data. What matters is the medium-term trend, and that has shifted positive. For high net worth individuals, this means maintaining your India allocation. If you have been sitting on excess cash, waiting for the right time, you are potentially missing the opportunity. The right time is when fundamentals are strong and the prices are reasonable. And that is exactly where we are currently. However, given the short-term volatility from FII activity, we recommend astute investors and the traders, they can also go on derivative ways of hedging their portfolios with covered calls and some other things they can look forward. Now, this comes us to the next session called the sectorial winners and losers. Now, the markets don't move uniformly, and this week was a perfect example of sectorial divergence. Banking and financial services were the heroes of this week. The Nifty PSU Bank Index showed particular strength. Bank Nifty held ground while the broader market struggled. Real estate gains 2.23% in earlier sessions, and this is reflecting something that urbanization, infrastructure development, and genuine demand and not speculation. On the flip side, media stocks declined by around 2.5%, metals down by around 2.07%, consumer durables by around 1.98%. Now, mixed signals, near-term pressure from global demand concerns, but long-term tailwinds from AI and digital transformation still remain intact. What is the underlying theme here? The market is favoring domestic consumption stories over globally exposed sectors. Yes, the market is favoring domestic consumptions over globally exposed sectors. Now, banking serves as the domestic economy. Banking serves as the domestic economy. Real estate is driven by Indian urbanization. Now, this tells us the market believes India's growth will be internally driven and not dependent purely on the global demand. What is our point of view on this? At Finogent, we are constructive on the sectorial rotation. It is consistent with our thesis that India growth story is becoming increasingly self-sustaining. Our recommendations on sectorial allocation, like people over a medium to long term now can look forward to banking and financial. Large private banks are doing good. PSUs and are also trading below book value, and their asset allocation is also like asset quality is also improving. NBFCs with their niche focus area like housing finance, gold loans, microfinance are there. Real estate, through the combination of direct investments into real estate, construction, premium projects, REITs. So there are certain sectors and themes which are really very lucrative, which an astute investor or an advanced investor can look forward to. Firstly, zoom out, because individual stock movements and sectorial rotation, they all happen within a macroeconomic context. And India's macroeconomic picture, it is remarkably solid. The Reserve Bank of India projects GDP growth at around 6.5% to 6.8% for FY 2025-26. That makes India the fastest growing major economy globally, and this isn't a flash in the pan. Q1 of FY 26 surpassed positively at 7.8, driven by genuine drivers, private consumption, fixed investment. Here is what excites me. Inflation is projected at just 2.6% for 25-26. That is well below RBI's target for 4%. Why does this matter? Because low inflation with high growth is the Goldilocks scenario. What does this mean? Real returns for investors are strong. RBI has room for accommodative policy, pricing power without demand destructions. Consumer purchasing power remains robust. And the government capital expenditure to the GDP ratio is rising 4.3% for 25-26 from 4.1%. Now, that's continued infrastructure push, roads, railways, airports, digital infrastructure. This isn't just GDP growth, it is capacity creation for the next decade. What is our point of view in this? The macroeconomic foundation is why we remain structurally bullish on India despite tactical volatility. You have growth without inflation. That is a real economic history. How we look at it is themed investments, like when you have a lower inflation, lower repo rates, infrastructure, capex do good, engineering and constructions are there, capital good manufacturers like transformers, switch gears, turbines are there, logistics and warehousing is there. Considering InvITs, infrastructure trusts, structures being there, consumption theme being there. So these are, the focus should be on the aspirational consumption and not basic consumption. Discretionary sectors like automobiles, where premiumization trend could be seen, QSR chains, multiplexes. So all these are there. Now, what are the global factors impacting the Indian market? No matter how strong Indian domestic story is there, but we are not an island country. Global factors matter, and there is a lot happening internationally. Gold has surged nearly to $3,986 per ounce. That is unprecedented. The US dollar index has declined by to around 4.4% over the last year. What is driving this? Safe haven demand, central bank buying, and monetary policy divergence. Yes. Crude oil tells the opposite story. Brent crude around $63 to $64, WTI around $60. Oversupply concerns dominate. Projections suggesting there's surplus of oil being around 2 million barrel per day in 2026. For India, lower crude is unambiguously positive. Yes, it reduces our import bill by billions of dollars, eases the inflation pressure, supports the current account deficit, improves fiscal space, and the US government shutdown, now exceeding 36 days, the longest in American history, has injected uncertainty in global markets. Yes, Federal Reserve rate cutting trajectory continues, but trade tensions persist. What is our point of view on this is global volatility is the price of admission for equity returns. Yes. But here is what sophisticated investors understand. Global uncertainty often benefits India as a relative safe haven within emerging markets. How we look at it, global diversification and hedging, gold allocations. Gold allocation might not at this time be for the returns, but for the portfolio insurance. allocations through physical golds or gold ETFs or some other way, or even the gold mining stocks for that matter. Now, for the HNIs with international exposure needs, current dollar weakness is an opportunity. Consider building dollar assets incrementally and US money market funds yielding 4.4 to 5%. Some even US good stocks are doing good. Now, don't hedge 100% of your dollar exposure. Keep 30-40% unhedged to benefit from the potential reversal. Now, let me address something. HNI investors constantly ask, beyond stocks and bonds, what we are looking at. Do we have something? No, alternative assets aren't just for diversification. They are different return profiles, different risk characteristics, and different liquidity timelines. Now, real estate, for example, this sector is genuinely strong right now, but not all real estates are equal. Direct premium residential in Mumbai, Bangalore, Pune, under construction projects from grade A developers with track records. Why? You are buying at a pre-launch price. You get 15 to 20% of the discount for the ready inventory, and a capital appreciation plus rental yields gives you around 12 to 15% IRR over 4 to 5 years. Now, commercial real estate through REITs, you are getting 5.5 to 6.5 as a distribution yields, potential for capital appreciation, and also along with the professional management. Now, this is a real estate without the hassles. Yes, REITs are real estate without the hassles. Now, AIF and PMS for high net worth individuals, these are optional. They are essential for alpha generation. Category 3 AIFs focusing on long short equity strategies can generate returns uncorrelated to market direction. PMS with concentrated portfolios of 15 to 20 stocks can meaningfully outperform indices. And market linked debentures, MLDs, offering capital protection with equity participation. Yes. In this environment, 80% of the capital is protected with 70 to 80% participation in the Nifty upside over 3 years. Now, that is compelling for the risk-averse wealth. What is our point of view on this? We believe in evidence-based asset allocation, stories or trends. Here is how we would structure a client having a 10 crore of the portfolio. Normally, when you're structuring the portfolio, there has to be a core portfolio and there has to be a satellite portfolio, and then there has to be a fractional allocation to AIF and PMS opportunities. There has to be some pre-IPO, some foreign currency, commodities into the kitty. But it all depends. Just because you are having a 10 crore of the portfolio doesn't mean that you deserve that portfolio or you are fit for that portfolio. It also depends upon your investor psyche, risk appetites, your current financial status, the money that you need at any given point in time. But these different asset classes, some of which being uncorrelated, can actually provide much buffer to your portfolio and also better risk adjusted returns. Now, what are the risks we are monitoring? Now, let me be completely transparent about the risk, because sophisticated investing isn't just about ignoring the risk, it is also about understanding and managing them. The near-term risks, what we are looking at, FII flow reversal. The early November shift to profit booking could intensify if the global risk appetite deteriorates. We are watching this daily. Geopolitical uncertainty could be another factor. The prolonged US government shutdown, Middle East tensions, Ukraine crisis, any escalation on any aspect can create volatility. Then we are having the valuation concerns. While large caps are reasonable, mid and small caps are trading at a premium valuations. Selectivity is crucial. Domestic risks, inflation resurgence, food prices being unpredictable, any sharp spike could force RBI to pause accommodation. Urban consumption weakness could be there as one of the risk factors. Some indicators show that the urban demand is softening. Now, if this persists, it affects the corporate earnings. Election uncertainty could be the another factor in the key states. Yes, because state elections can also impact the policy uncertainty and leading to sentimental shifts on a broader scale by to the central government. What is our point of view? Risk management isn't about eliminating risk. It is impossible. You cannot eliminate the risk, but yes, it is about ensuring risk is adequately compensated and do not sink your entire portfolio. When we look at it, risk management portfolio should involve the portfolio level hedging, whether you are writing calls or puts for that matter, you are using derivative strategies. That is the one way the astute investor can go. You're doing position sizing or you're doing tight stop losses, or even if at the asset allocation level, you might not be going to thematics. And even if you're going to thematics, you are following the very strong sectorial or segment level asset allocation, making sure that you have sufficient emergency corpus with you, staggering the deployment over a certain period in time, getting the stress testing of your portfolio done. If the Nifty corrects by 15%, how much your portfolio will fall. But believe you me, if you're doing stress testing and you say, okay, if the market falls by 15%, my portfolio only falls by 10%, then that means your beta of the portfolio is lower. What does this mean? This means if tomorrow the market goes up by 15%, your portfolio will go up by only 12%. It will not go up by 15% or 20% for that matter. So if you're having a lower beta, so it may not fall much, but it will also not beat the indice for that matter, the benchmark for that matter. So after discussing the risks, let's talk about what excites us, because every market environment creates opportunities. We just need to know where to look. Yes, what are the structural themes we are looking at? We are very bullish about, yes, Digital India 2.0, which is not just IT services. We are looking at the entire digitization, which includes digital lending, insurtech, health tech, and TAM, total addressable market. And that is actually expanding exponentially. Premiumization across sectors. Indian consumers are upgrading their cars, homes, electronic equipments, dining, and everything. And therefore, the companies that are providing those products and services, they will be making money. Yes, companies which are catering to the aspirational consumption will be outperforming. Manufacturing renaissance, PLI schemes are working. Electronics manufacturing, semiconductor assembly, EV components, toy manufacturing. India is becoming the manufacturing hub, not just for cost but for capability. Now here you have also energy transition coming up, renewable energy, EV ecosystem, battery storage, green hydrogen. Now this isn't a 2-3 year theme, it is a 20-year mega trend. So therefore, if you are making an allocation and you're thinking that, okay, I will make money and how much I will make in 1 year, then you're doing injustice to your own portfolio, because it's a 20-year mega trend. So you can't invest with 1 or 2 year of the horizon. You have to be a longer horizon for that matter. And then there's the healthcare and all other things that go with it. So these things that what I have told you, they are not just themes. They are the sectors where we are seeing real earnings growth, real purchasing power, real competitive advantage being built. Our recommendation is, while you are having an asset allocation and if you're actually going for thematic allocation, please don't do it alone if you don't have any experience, because thematic portfolio comes with cyclical things. Now, if there are cycles in thematics, you won't be able to exit at the right time. You might be stuck with lower returns and your portfolio being dragged over a longer period in time. So the efficiency of the portfolio might not be there. So it all depends upon how your investing style is, how much comfortable you have been previously also with your investment, and many other factors. So for the next 30 days, what you should as an investor do? So if you want to get tactical, what you should be doing in next 30 days, next 7 days should be based on your portfolio audit to be done, pull out your holdings, see that your current asset allocation, how it pans out with your target asset allocation, and whether it is in sync with your risk appetite, investment horizons, and whether the underinvestment or overinvestment is not there, whether the portfolio is not biased, and make sure that you analyze it completely and then recalibrate your portfolio as per the current change in macroeconomics and expected returns that we expect. If you are watching this far, let me leave you with some final thoughts. Markets are always uncertain. There is always a reason to worry. FII outflows, global slowdown, valuations, geopolitics. But here is what I have learned over 2 decades in the business. The wealth is created by participating in the structural growth stories and not by timing the tactical ups and downs perfectly. India's structural story is intact. We are in the middle of a multi-decade transformation, whether you talk about digital, financial, infrastructure, manufacturing. Now, this week's consolidation, it is just a noise in a longer journey. Now, market consolidation is healthy after a recent rally. It is not a reason to panic. Second, FII flows have structurally improved despite tactical volatility. Third, domestic themes are outperforming: banking, real estate, infrastructure. Fourth, macro foundation remains solid. Growth with low inflation is a Goldilocks. Fifth, global factors are mixed, but the lower oil and gold diversification help India. Sixth, risk exists but are manageable. Proper hedging and diversification are the key. Seventh, opportunities abound. Digital India, premiumization, manufacturing, energy transition, your action items for that. Look, I manage my own wealth alongside advising high net worth individuals at Finogent. Everything that I have shared today and I am doing in my own portfolio. This is how I look at my portfolio also. If you're feeling overwhelmed, that is normal. Investing at a high net worth individual level requires expertise. That is why we exist, to be your thought partner, your sounding board, and your execution partner. If you found this analysis valuable, please like this video and subscribe to our channel. We will be here every week doing the deep down analysis on the markets. No recommendations, no fluff, just a guidance to you on how to manage your portfolio better. Visit www.finogent.com or drop a message down. Thank you so much. Have a great day.